Welcome. Today we're talking about FHA loans. This is a loan program under the Federal Housing Administration, which is part of the Department of Housing and Urban Development. And today we're going to be referencing the Single Family Housing Policy Handbook, which we have on screen right now. So, to start, this is a federal program. It's not an actual loan. Loans are going to be provided by lenders that comply with the guidelines of this program. The loans are insured by the Federal Housing Administration. So why do people look at this type of loan? Two of the primary reasons are the credit score requirements. If you look at an FHA loan, we're sitting at 580. Compare that to a conventional loan where the minimum requirement is 620. And as always with the credit score, that's how you get in the door. That's not optimally where you want to be at, but that's how you first get the loan. Typically, as the credit score increases, the terms are going to get better for the borrower. The other point that makes this attractive is the lower down payment. So for a conventional loan, you're going to be required to put down 20% in most cases. On an FHA loan, that goes from 10% and down. You can get down payments below 5% for one of these program loans. So let's talk about escrow. What is it? Escrow is money that's held by a third party for payment of a specific obligation. And so what that means for you is that you're going to have bills due outside of your loan, right? And these bills are going to be your insurance, your property taxes, other things. You could see there's a whole list here on screen of what this includes. But that money is going to be collected by a third party, right? So the obligation is between you and the taxing authority or the insurance company. But there's a third party involved, and that's your lender. What the lender does is they're going to collect this money from you, and they're going to send it on to who you owe the money to. And again, this is going to include your property taxes, your insurance, like that's all going to be in escrow. You're not sending a check to the county. This is going to be handled by your lender under this program. On your mortgage statement, that's going to be a line item is the escrow. Just know that it includes all these things, but there's going to be three primary items. There's going to be the loan payment, there's going to be the loan interest, and then there's going to be your escrow. And that escrow includes your mortgage insurance premium, which is something that's going to be required for this type of loan. Mortgage insurance is not for you. This is for the lender. This program was put in place to help increase home ownership, specifically for those who normally would not qualify for a conventional loan. Because of that, because they don't qualify for a conventional loan, the lender is looking for some protection in case the borrower defaults. And that comes in the form of this mortgage insurance premium. And this is paid two ways. It's paid up front, and then it's paid on a monthly basis. The upfront mortgage insurance premium is 1.75% of the base loan amount. So if you get a $100,000 loan, you're going to be paying $1,750 upfront when you close on the property. On a monthly basis, there's going to be a couple factors here, but you can see the range goes from 0.8 to 1.05%, depending on the type of loan that you get and the duration and the loan to value ratio. So what's the loan to value ratio? Because that's important here. That's the ratio of what your loan is to the purchase price of the property or the value of the property, right? So let's say you have a $110,000 loan. I'm sorry, $110,000 property, and you get a $100,000 loan. That's going to be a 90% loan to value ratio, right? So, and this is rough math, don't break out your calculator, it might be a little off. But in that case, you're going to be in that top line where you're going to be paying 80 basis points, which is 0.8%. And that means that every year, because you have a $100,000 loan, your mortgage insurance is going to be $800. Take that 800, you divide it by 12, and that gets tacked onto your mortgage statement, and that goes in your escrow box. Why is that important? Well, because if you have a 90% loan to value ratio, that mortgage insurance premium is going to be in effect for 11 years. Once you go higher than 90% LTV, it's going to be in effect for the term of the mortgage. So until you either pay the mortgage off or you refinance it. So it's something to keep in mind. That mortgage insurance premium can be with you for a while. If you're on the path of improving your credit and your finances, that might not be an issue for you, because at some point in the future, maybe even before the 11 years, you're going to go through and you might refinance it anyway, just to get some better terms. But if not, just keep in mind that as you have that higher loan to value ratio, the lender is taking on a bigger risk, right? If it's 99% loan to value, you're putting down 1% for the property, the bank's putting down 99%. So they're going to look for this insurance. All right, another item is closing costs. And this is specific to this type of loan where there is a 6% contribution from the seller that can be applied to the borrower's closing costs. And why is this important? Compared to a conventional loan typically caps that contribution at 3%. So this is something that works both ways, and there should be some consideration to what the market trends are. If you're in a buyer's market, sellers are going to be looking to provide incentives to complete the transaction. And this is something that you'd want to leverage because it's a maximum of 6%. You might want to put that to the buyer, or I'm sorry, to the seller, right? Because in a buyer's market, sellers want to incentivize people to buy the property, and they don't really have the option of picking the best available offer. They're in a position of providing incentives to the borrower to make them want to purchase this property. So that's a case where you'd want to maybe push that a little bit. In a seller's market, that is not such a good idea, right? Because in a seller's market, the seller has the option of picking what's best for them. And it's not in their best interest to take money off of what they're going to collect once they complete this transaction. And so for them, why would they offer 6% to a borrower when they have other offers where the borrowers are capped at 3%, or they might even be reducing those below 3%, or indeed offering higher than the asking price, you know? And so it's something to consider in terms of the market, how you want to use that 6%, because it's not just you and the seller that are looking at this transaction. The seller is going to have other offers from other borrowers with other loan products that may or may not be as competitive or more competitive than what you're coming to the table with. Hope this has been informative. Let me know what you think in the comments below. Thank you.